I'll be doing this one on my own today, kind of tackling some of the questions that we've been receiving from clients this month, because if they're having them, then you probably have them. And so we're going to talk a lot about data today, kind of what the market is showing, some trends that are happening, and kind of things that we are doing currently to prepare for kind of the changing environment. So with that, we'll get started. So the first thing that we want to talk about here is inflation. And inflation truly is, kind of the thing that is running the market right now. And so one of the topics that we want to certainly address is what's happening right now and kind of what are the trends that are happening. So you can kind of see from our slide here that in early 2021, we had some pretty low numbers. Okay, and then really since then, this is kind of the consumer price index number that we're looking at. The numbers have kind of steadily increased from 2021 all the way down to kind of currently where we're at. So we had inflation, which the Fed is trying to target at about 2%. Things were looking good there in early 2021. They started to increase all the way kind of through that April timeframe and almost all the way through 2021, and have really kind of steadily increased through there. So in 2022 here, as the markets are down about 24% leading into the week, what's kind of happened? So we saw kind of a steady increase all the way through 2022. We got to the March timeframe. We thought maybe we saw a drop. And if you remember kind of in the March timeframe of 2022, the S&P was down and started to make a little bit of a comeback through April. And then as we continue to get more and more inflation numbers that were not trending in the positive direction, we saw market low when we had our highest inflation number in June. So on June 17th, we had a really big market low. And then we kind of have some more good inflation news. It started to drop again. The market started coming back. And in August, the Fed met and kind of said, hey, we're going to continue to raise interest rates. That's going to be the way we're going to calm inflation. So that rhetoric that the Fed has been kind of speaking about is, hey, we're going to continue to be aggressive, is really what's influencing the market so much recently. And so everyone was kind of anticipating them raising the rates. It was just their discussion, the way that they were talking about it, saying, hey, we're going to do this, buckle down, essentially, right? We're going to experience some pain. And so with all of that kind of negative talk, the markets have gotten a little scared. And so the markets have kind of worked back through August. They were down about 25%. And I'm talking about the S&P kind of gotten down 25% through June and bounced back through August to get down to about 15%. So we got about 10% of that drop back. And then that talk came out. We've really seen a big decrease leading up to this week. And again, it has just been more the Fed saying, hey, we're going to raise rates, and the word don't think this is going to stop. We're going to continue doing this. So the markets have kind of pulled back. Now today we're starting to get some positive news. Yesterday was a good day in the market. So far today has been a good day in the market. And a lot of that's becoming because people are saying, hey, the rhetoric's changing, right? We think the Fed may be kind of being forced or being a little bit softer, gentler with the way they're talking. And so the market's thinking that maybe the Fed won't be as aggressive or as long. But again, all of this goes to, we've seen kind of this whole movement all year, right? In March, we saw some good news, a little bit of positive talk. The markets were ready to take off. But then we had more negative talk, a little bit more poor data. Markets dropped back. We got some really good news again coming out of that. Markets started to come back. Then the Fed comes out and says, we're going to be aggressive, and we get a big pullback. Now people are thinking, maybe the Fed's not going to do this. So we're seeing the markets kind of start to come back. So it's been kind of this push and pull all year round. But I think what makes some of these strong comebacks happen so quickly is we do have a strong fundamental economy underneath it. And we'll talk about that today. So people are spending money. Companies are making money. That's why anytime we get any slight bit of news, which we did in March, we did in June, we're doing a little bit now, that's why the markets are coming back so strong. So once we start to see data trending the right way, and we start to see inflation kind of being calmed down, we think it's possible that the markets come back really quickly. And that's the kind of the trends that we're going to show today, okay, as we go through this presentation. So when we talk about some of the things that have happened, we just got a number that came out about personal consumption. All right, so this is the amount of money people are spending. They're consuming goods. We can see kind of since 2013, we had a huge increase. 2020, right? We see the coronavirus happen. People are really pulling back during that time period, not spending money. We had unemployment get really high, which we'll talk about. But again, right, we were like, we're never going to be allowed to work. Companies were shutting down. People were parking airplanes on taxiways. Every restaurant was empty. Every hotel was empty. People were unemployed. Okay, so we saw that big pullback. people stopped spending money and they started saving money during that 2020 timeframe. Then we kind of get all of this government spending throughout 2020 and 2021 that has really led to a lot of this increase in consumer spending. And the number that just came out last Friday was that consumer spending has increased by 0.4% month over month. Again, if you remember the markets on Thursday, Friday last week, not very good. Again, we see these things because consumer spending means companies are going to continue to raise prices, right? If people keep spending money, companies are going to raise their prices. So they're going to continue to make money, trying to slow down because they need to make sure that they keep up with that demand, and so they can increase their prices. So that's some of the trends that we're seeing so far. And this is not a good number that we're seeing is we need people to stop spending money. That's why the Fed continues to raise interest rates, is because they're trying to get people to spend less money. But the good news is we're starting to see some kind of data that might show that may start to happen, right? So here's kind of excess savings. And what you'll see is excess savings increased about 2.1 during that COVID-19 government spending, right? So that's all of this cumulative excess savings that happened. Kind of this light pink here is personal savings pre-COVID level. And then you'll start to see January 20 of 21, we really saw that increase. And that's all of that excess government spending coming in. When the market gets tight and we kind of get a little bit scared, people also start to save a little bit more money, right? This happened during 2008. This happened now. When markets are really, really scared, people stop spending money and they start saving it, right? Because they're worried about, are they going to have enough money? Should they get laid off or anything like that? So we see this excess savings happening during that 2020, 2021 timeframe. So we get all this excess savings, which led to excess consumer spending once people started saving it. Plus, you get all that government spending coming in, and people continue to spend money. That's why companies are making money right now. We talk to our small business owner clients. They say 2021 was their best year. 2022 is on pace to beat 2021. Again, all kind of excess spending. People spend money, companies make money. But we're starting to see maybe in 2022 here, some trending downward. So it's decreased about 1.3 trillion as of August. So again, right, still have more money, which means people are going to continue to spend money, which kind of goes back to our previous slide, that consumers keep spending money because they have excess savings. But things are trending in the right direction. Okay, maybe people are going to not save as much. You can kind of see savings decreasing from pre-COVID levels as inflation starts to eat away in the purchasing power for people. Okay, so another thing that's really happened was the housing market. We're starting to see bad housing data market. And again, that tends to be a leading kind of indicator. And what we're seeing in the housing market makes a lot of sense. Fed's raising interest rates. Houses that people could afford at 2.5% to 3% mortgage rates aren't as affordable at 6% and 7% interest rates. So people have stopped spending as much money kind of on purchasing homes. But the rental market has been extremely strong. People have gone out and bought homes, raised rents on people. And because they can kind of get away with it, plus you got to remember they weren't getting paid necessarily in that 2020 timeframe when the government came out and said, hey, you don't have to necessarily pay your rent. And so all those things happen. Those people need to get their money back, so they start to raise rents. So we saw rents kind of increase for a really, really long time. It's been one of the biggest indicators in inflation up to this point was we had a lot of rental increases. The good news is we're starting to see some of those rental increases decrease. So over the 4-quarter supply of additions were outpacing demand, meaning there was more supply being put in the market than the demand was there for kind of purchasing those things, which led to a higher rate of increase for rents. However, that's starting to shift. So the rental market is shifting with asking rent decreasing by 0.4%. Okay, so we saw a negative trend kind of asking prices for rents. Again, a sign that maybe inflation's starting to calm down a little bit. Again, those are the kinds of things we're looking for because we feel like we have a strong market underneath it that we can get some really positive movement out of that. Should this data continue? Again, this is all kind of snapshot in time. So another thing is the used cars prices. Okay, another really big kind of data point for what's happened with inflation. So what we've seen kind of with used cars, right? If you haven't been in the market for a car lately, it hasn't been a whole lot of fun. Is kind of through that same 2020 time period. Then came all that excess money. Again, more excess savings. People are going out buying used cars. They're actually paying more for a used car than they are for a new car because they can get it right now, right? So rather than being patient and waiting for the market to change, people are buying a used car paying more than it's actually worth. That was driving up prices. But again, we're starting to see maybe a shift in used car prices, or at least the inflation reported on those. So again, the market is starting, again, another data point that maybe things are changing, things are shifting, which will all kind of be kind of good news for inflation, hopefully changing. Okay. Another thing that we're looking at is the unemployment rate. The Fed and the White House has said, hey, we don't really think we're in a recession, even though we've had two negative quarters of GDP, and even though the market's down over 20%, we don't believe that we're in a recession. The reason they say that is because the unemployment rate has been so low. You can kind of see going back to early 2002, unemployment was there. We saw the 2008 timeframe when the housing market crashed, unemployment rose to around 10%, drove it back down. Then all of a sudden we got to the 2020 timeframe again during that coronavirus recession where people were laid off, people were not spending money, people were saving, people were losing their jobs. We saw unemployment spike to about 14.7%. It's been sharply decreasing with all that government spending, getting people able to go back and hire people. They hired people, and now we've had unemployment really, really low. So low unemployment, wage growth, excess savings has led to people spending lots of money. People spending lots of money has led to this excess inflation. But maybe the data is starting to show that things are decreasing. So these are the things that we're looking at over the next quarter to find out when should we kind of say it's time to get back in the market, time to be aggressive. And we've always been in the market. We know these things are happening. What we don't try to do is time the market because we don't know, as we've seen already this year, when we've seen the bottom. Again, maybe we saw it in March. We had good signs. It kind of decreased through June. We saw good signs. It kind of increased from June to August. Then we kind of get more rhetoric, drops it back down through kind of where we're at today in the beginning of October. We're starting to see good signs. We don't know what happens with some of the key dates that are coming up and some of the key data that will come out. And again, we'll kind of go through some of that a little bit later. But know that that's kind of what's been happening in terms of graphs and data to show overall what's going on in the market. Okay, so some of the key dates that are upcoming, right? 7 October, this Friday, we're going to get an unemployment number, right? We're going to start to find out what is happening with that unemployment number. Are we starting to see an increase? It's kind of counterintuitive. We generally want low unemployment. That means a strong economy. But if we get an increase in the unemployment number, does that mean that the Fed might pull back on some of the interest rate hikes, which is kind of leading to kind of the increases in the market today and yesterday, was people think maybe the Fed's not going to be aggressive. We get a rise or an uptick in unemployment, maybe the market starts to say, okay, that's going to force the Fed to lower rates and kind of get a little boost in the market, right? Again, that's just a snapshot in time, though. It doesn't mean it will continue, but kind of look for things that may happen with the unemployment number comes up this Friday. And then, what is it, next Wednesday, the 13th of October, we're going to go ahead and get our next CPI number. So we go back to that beginning chart. We saw 9.1, it dropped to 8.5, it dropped to 8.3. Are we now in the sevens? We starting to see rental prices decrease, used car prices decreases, all that going to be reflected in the consumer price index, come the mid-October number. Again, that will be another sign for what happens with the kind of the movement in the market, the volatility. Then on the 2nd November, we get the Fed meeting. That will be kind of the next time that they're going to announce their interest rate hikes. We'll start to see data come out, people's predictions about what they think the Fed will do. Are they going to do another 0.75% interest rate hike? Are they going to only do 0.5%? As we start to hear more, again, the markets will be volatile trying to predict. And if the markets get it wrong, we could see another big pullback, right? This is kind of where we're at in March, June, August. Every time the Fed talks, the markets move, right? We want to kind of see, are they going to continue to raise interest rates and how aggressively will they do that? And so we'll see some movement there. Election day always brings out a lot of emotion because it is so passionate, especially in 2022 with all the social media and all the nonsense out there. But that will bring a lot of emotion. Again, we've done reports on it. Typically, it doesn't really matter in the market, right? Long term, near term, right? It kind of creates some volatility. So I think we'll see something there. It also leads to some of the debate and some of the question on there. Do we get a more positive news from the Fed as they try to influence the election, or what does that look like? They're supposed to be independent, but they also have a boss to report to. We'll see. Does that kind of influence the market since those dates are so close? If we get really bad data and news here, we could see the markets crash and people could flip their vote because they're a little bit nervous about those things. So it'll be very interesting to see how this plays out. If you're a nerd like me, strap in. It'll be a good ride. But these are the numbers that we're looking for and kind of things that we're monitoring over the course of the year. Again, I think when we go back and look at what happened in March, June, and kind of what's happening this week, all we need really is good news and the market is ready to go. It's been 10 months now of kind of getting punched in the gut with this market and kind of our emotions being toyed with as we see bad news and then good news and bad news and good news. So we've kind of tested that market low from June over the last week or so. So those are the things that we're kind of monitoring. Those are the questions that we've been receiving from people. We want to make sure that we're communicating with you the things that are kind of on our mind. If you have any questions, don't ever hesitate to reach out. But until next time, we're out from Bolt Financial Group.